Greetings, everyone. Wherever you're watching from, please share in the comments what day and date it is for you right now. Very quickly before we begin, I'm conducting a campaign to eliminate copycat channels. If you value what I do here, support me by subscribing and commenting these 3 words. Let's discuss silver, and yes, gold too, because the two are moving like relatives in the same storm. Here's what I'm observing. We have a market that keeps oscillating back and forth, almost as if it cannot decide what narrative it wants to present. That's where the real story usually resides. I'm going to walk you through several specific signals that have appeared in recent market updates. Nothing exotic or mysterious, just the kind of data that sits publicly available, but most people don't connect together. Once you connect them, the picture can become uncomfortable. Let's start with the obvious surface level. Silver has been trading around the low 80s per ounce in recent sessions after sprinting much higher in late January, then whipping back down again. That's not a normal looking chart. That chart indicates 2 things are happening simultaneously. 1, there's genuine demand underneath it. 2, there's substantial leverage sitting on top of it. When you get that combination, you don't get smooth trends. You get these violent, sudden snaps. What tends to trigger those snaps? Sometimes it's just emotion, but frequently it's collateral, margins, haircuts, and financing. In fact, the main futures venue has just raised margin requirements again for gold and silver. For silver, the increase pushes requirements up into the high teens as a share of notional value. That matters because higher margins don't change the narrative. They change who can stay in the narrative. If you're over-leveraged, you get pushed out. If you're conservative, you get a discount. This can create a strange effect where price can drop hard even when underlying fundamentals are tightening. So if you've ever watched silver fall on a day when everything should be bullish, that's one clear explanation. Now let's discuss the dollar, because the dollar has been quietly easing, and silver notices that. The dollar index has been sitting in the mid-90s recently, and it's been softer year to date. That's not magic, it's just arithmetic. When the unit you price things in weakens, hard assets tend to look stronger. But I want to be careful here. A weaker dollar doesn't automatically mean silver goes straight up. It means the wind isn't in your face, that's all. So the question becomes, if the wind is at your back, why is the market still acting so jumpy? This is where we have to zoom out and then zoom in, zoom out to the global picture and zoom into the physical channels. Because the most important thing happening right now isn't a tweet, a rumor, or someone's price target. It's where the metal is and who can access it when they need it. Let's go to China and let me frame this practically. Over the next couple of weeks, there's a holiday trading disruption window in the Chinese precious metals complex. There's no night session on Friday, February 13th. Then the Shanghai gold venue is closed from Sunday, February 15th through Monday, February 23rd, resuming on Tuesday, February 24th. Why do I care? Because when a major liquidity hub steps away, price discovery shifts. It doesn't disappear, it relocates. During that window, Western paper venues carry more of the load. That can mean wider spreads, thin liquidity, and sharp moves that don't feel fair if you're accustomed to steady trading. I'm not even accusing anyone of anything, I'm just describing a mechanical reality. If one big pool is closed, the other pool looks deeper than it really is. Here's the part most people miss. You can have a holiday schedule, and that's normal. But when you combine it with low inventory signals, that schedule starts to look like a stress test. What do the inventory signals say? From recent inventory trackers, Shanghai silver stockpiles have been hovering slightly above 300 tons, and the direction over the past years has been lower compared with the highs seen earlier in the decade. I'm going to give you a skeptical caveat right here. Inventory data is messy. Different reports track different categories. Some track deliverable, some track total, some track warehouse receipts, some track bonded stock. So you cannot take one number and declare the world is out of silver. That's not how this works, but you can watch the trend. And the trend is one of tightening, not loosening. That matters more than the exact count to the last ounce. Now, let's connect that to spread signals, because spreads are the market's mood ring. In a calm market, spot and near-month futures will usually trade pretty close together. In a stressed market, you start seeing premiums, discounts, and odd little dislocations. In China, traders have been discussing a noticeable gap between physical pricing and forward pricing. In plain English, the future price can sit above the immediate physical price. That's called contango. Contango by itself is not proof of a squeeze. It can reflect storage costs, financing costs, or just holiday settlement timing. So here's the skeptical alternative interpretation. Maybe this isn't a shortage signal at all. Maybe it's a calendar signal. Maybe it's just dealers pricing in the cost of carrying metal through a closure window. That's possible. And if that's all it is, the spread will compress when normal trading resumes. So we don't have to be dramatic, we just have to watch. That brings me to the question I want you to answer for me in the comments. Do you think these China spreads are a real physical warning, or do you think they're just a holiday distortion? I'd love to know what you think. Now let's pivot to the other piece of the physical story, the U.S. futures warehouse system. Because this is where people get confused. They hear inventory and imagine a vault with piles of metal. But in warehouse reports, there are categories. There's metal that is eligible, meaning it's inside the approved system, and there's metal that is registered, meaning it's in deliverable form for futures contracts. Those are not the same thing, and that difference is everything when people start talking about delivery stress. From the latest daily warehouse report, the registered category for silver is sitting slightly over 100 million ounces, while eligible is closer to 3 times that. What does that tell us? It tells us 2 things at once. 1, there's a lot of silver inside the system. 2, only a smaller slice of it is immediately deliverable without someone choosing to reclassify it. And the key word is choosing, because in a squeeze environment, the market doesn't ask, is there silver somewhere? The market asks, will the owner make it available at this price? That's a very different question. If you think prices might run, you hold. If you think prices might fall, you sell. So the conversion from eligible to registered isn't a technical switch. It's a psychological decision. Here's where the paper versus physical argument gets heated. There are numerous paper claims floating around relative to the registered pool. Sometimes that's fine because most people roll their contracts or settle financially. But when more people demand metal, the ratio starts to matter. We've seen in recent months higher delivery intensity in precious metals contracts, higher volatility, and higher margin demands, all at the same time. That combination isn't normal. It's not proof of default, but it is proof of stress. Now let's add one more layer, positioning. Because the market isn't just bars and coins, it's also bets, and bets can become crowded. The U.S. regulator's weekly positioning report shows that open interest in the main silver contract has been sitting in the low 140,000 contracts, and the speculative crowd has been leaning net long. Again, I'm simplifying, but the direction matters. When the crowd is leaned in one direction, the market becomes more sensitive to margin shocks. That's how you can get those sudden down days. Not because the story changed, but because the collateral changed. The competing narrative you've probably heard is that there's a single villain shorting the market, a single big short who must get squeezed. I'm going to challenge that because markets usually don't work like comic books. Yes, it's possible for a concentrated position to distort pricing. Yes, it's possible for a forced buyback to create a violent spike, but the bigger structural story is often more boring and more powerful. The bigger story is steady physical demand meeting a system optimized for paper turnover. When those two collide, you don't need a villain, you just need time. Let me bring in some fresh context that almost no one mentions when they get excited about silver. Industrial demand isn't static. It shifts, it substitutes, it economizes. A recently published industry survey expects global silver demand to hold roughly steady into this year, but it also expects industrial usage to soften slightly as manufacturers reduce loadings in certain applications, especially in solar. That's important because it means 2 opposite forces are operating. On one hand, solar and electrification are enormous trends. On the other hand, engineers are really good at using less of what gets expensive. So if silver gets too high, you can get substitution, and that can cap the rally, at least temporarily. That same survey also expects physical investment demand to rise meaningfully, led by Western buying. That's the key tension. Do we get an investment wave that overwhelms the economizing, or do we get economizing that dulls the investment wave? That's the tug of war. Let's add one more macro layer. There have been fresh reports suggesting Chinese authorities have encouraged financial institutions to reduce concentration in U.S. government bonds. Again, we don't have to turn this into a grand conspiracy. It can simply be risk management. But when large pools of capital start discussing diversification away from one asset, the currency narrative can shift. And when the currency narrative shifts, precious metals get attention. I want to pause and speak to you directly because I know many of you are in this market for a personal reason. You're trying to get ahead. You're trying to build a buffer. You're trying to protect your family. If you're successful, share your success story in the comments so others can stay motivated. Let's get practical again. What should we watch next? I'm going to give you 4 things. 1, watch the dollar index. If it keeps slipping, that's a tailwind. 2, watch the Chinese trading window, not because it guarantees manipulation, but because it changes liquidity. 3, watch the warehouse categories, not the rumors, the categories, especially registered. 4, watch the spreads. If contango widens in a way that doesn't normalize after the closure, that's information. Let's talk about miners for a minute because people always ask me, should I buy the metal or the miners? The honest answer is it depends on your temperament. Miners can be leveraged to the metal. They can also be leveraged to chaos because miners have management risk, jurisdiction risk, financing risk, dilution risk, and the simple risk that the market just ignores them for long periods. In recent cycles, we've seen moments where mining shares lag the metal badly, then suddenly catch up in a burst when liquidity returns. That's not a guarantee, it's a pattern. And it's a pattern that repeats when investors move from I want safety to I want upside. Here's something you can do without any charting software. Ask yourself a simple question. Do you think we're in the phase where people want safety or the phase where they want upside? Because if it's safety, they buy the metal. If it's upside, they often chase the miners. Right now, the market feels like it's switching back and forth between those two moods. Let's talk about price targets because this is where people get carried away. You've heard the big numbers, 200, 600, 700. Sometimes people throw those out like they're inevitable. I'm not here to mock that. In fiat terms, extreme prices can happen, but I want you to think in a disciplined way. For silver to reach those kinds of levels, you'd likely need a combination of things. You'd need investment demand to surge. You'd need the currency narrative to worsen. You'd need industrial demand to hold up despite economizing. And you'd need the paper system to struggle to satisfy delivery expectations. That's a tall stack. Not impossible, but tall. Here's my second question for the comments. Which of those pieces do you think is most likely to be the catalyst? Is it the dollar? Is it the physical inventories? Is it investment demand? Or is it something we're not even talking about yet? The reason people love the big short squeeze story is that it feels like a movie. A villain gets trapped, a hero wins, the price explodes. But the reason I'm cautious with that story is because it can make you lazy. It can make you stop doing the boring work of watching the system. So instead of chasing a single dramatic trigger, I want you to pay attention to the slow grind. Because slow grinds create explosive moves. They create complacency, then they create surprise. Let me give you a simple analogy that I think is better than the famous ones. Think of the silver market like a small airport runway. On a normal day, it works fine. Planes take off, planes land. But if you suddenly schedule too many flights, it doesn't matter how big the planes are. The runway is the runway. You get delays, reroutes, cancellations, and sometimes panic. The runway in this analogy is deliverable inventory plus willingness to deliver, not total inventory somewhere in the world. Deliverable plus willingness. Here's where the fresh data becomes interesting. A federal geology agency, in its latest annual summary, estimates that domestic mines produced slightly over 1,000 tons of silver last year. It notes that a meaningful share of domestic use goes into electronics and photovoltaics, alongside coins, bars, and other industrial uses. We're not talking about a niche metal. We're talking about a metal that sits at the intersection of money and machines. That's why it gets emotional, because one crowd wants it as protection and another crowd needs it as an input. When both crowds want the same thing at the same time, the market doesn't stay calm. Let's talk about the demand war idea, but in a more grounded way. Imagine a manufacturer who needs silver every month. They don't care about price targets, they care about supply continuity. Then imagine a saver who buys silver because they don't trust paper. They don't care about inventory categories, they care about ownership. Those are different motivations. When volatility spikes, both groups can rush. Manufacturers rush to lock supply. Savers rush to lock purchasing power. That's when the shelves get thin. If gold is nervous, silver will not be calm. Silver is gold's hyperactive little brother. Before we go any further, let me slow down and explain something that sounds simple but trips people up. People talk about the silver price as if it's one single thing. It isn't. There's the price of a bar in your hand. There's the price of a futures contract that can be rolled. There's the cost of borrowing metal. There's the cost of borrowing dollars. And those costs can disagree for short stretches, especially in a volatile tape. So when you see a spread, your first instinct shouldn't be, squeeze. Your first instinct should be, what is the market charging for time? Because contango is basically the market putting a price tag on time. If it costs money to hold metal, the future price can sit above spot. If time itself becomes uncertain because of a holiday disruption window, the price tag can widen. I'm not going to tell you with certainty that contango means metal is gone. What I will tell you is this. In tight markets, spreads become more sensitive. This market right now is clearly sensitive. Let's bring in another fresh piece of context. Solar. Because solar is one of the biggest industrial narratives in silver, and it's evolving fast. A recent U.S. industry report said the country installed roughly 12 gigawatts of solar capacity in the third quarter of last year, one of the stronger quarters on record. That's a lot of new hardware, and yes, silver is part of that story. But at the same time, the industry has been actively reducing silver loading per panel over time. So you get this strange situation where installations can rise, while silver use per unit can fall. That's why you can have headlines that sound contradictory. Solar is booming and silver use per panel is shrinking. Both can be true. The latest demand outlook points in that direction. Industrial fabrication easing a little, partly because of economizing, while physical investment demand rises. This is the tug of war. Do we get an investment wave that overwhelms economizing? Or do we get economizing that dulls the investment wave? That's the real question, and it's one reason I'm careful with single cause stories. Let's address the default fear, because I know some of you are thinking it. You hear, registered is only slightly over 100 million ounces, and your mind goes straight to catastrophe. But let's keep it grounded. Registered is not the maximum deliverable silver on the planet. It's the currently designated deliverable category inside a specific warehouse system. Eligible can be converted, metal can move, bars can be warranted, and deliveries can be satisfied through more than one mechanism. So the system has flexibility. But flexibility isn't free. Flexibility has a price, and the price usually shows up as volatility, premiums, and distrust. I'm not predicting a cinematic implosion. I'm telling you the system is being asked to do more work under more stress with a thinner buffer. Here's the part that should grab your attention. When a market is calm, nobody cares about buffers. When a market is stressed, everyone suddenly cares about buffers. That shift in attention is itself a catalyst because it changes behavior. It changes how many people want delivery. It changes how many people hoard. It changes how many people stop lending metal. If you want to understand why silver can go from sleepy to explosive, it's not just supply and demand, it's behavior. Let me bring in one more fresh context anchor. The latest outlook expects global silver supply to grow slightly and recycling to rise meaningfully. Yet it still expects the market to run another structural deficit, again, in the neighborhood of several dozen million ounces. A deficit doesn't mean empty shelves tomorrow. It means the buffer is thinner. It means shocks hit harder. It means that when investment demand shows up, the market can't just shrug it off. So the next time you see a crazy daily candle, remember that the buffer is thinner. One more thing, based on recently published numbers, silver is already up in the low double digits this year, even after the pullback, which tells you the bid isn't imaginary. That kind of performance usually attracts new traders, and new traders usually arrive at the worst moment. So if you feel FOMO creeping in, slow down and remember, the market will still be here tomorrow, but your capital may not be. Let's circle back to the China narrative, but with a balanced lens. China is a major hub for manufacturing, trading, and warehousing. So when its venues pause, the global market notices. But it's a mistake to treat China like a single actor. It's a system. It has producers, consumers, traders, regulators, and speculators, just like everywhere else. When you hear a story about one big short position, take it as a possibility, not a certainty, and focus on what you can observe. Inventories, spreads, volatility, margins. Those are observable. Let me give you 3 likely scenarios in my view without pretending I know the future. Scenario 1. The holiday window passes, spreads normalize, and the market calms down. In that scenario, silver can still trend, but it does so in a choppy, frustrating way. Scenario 2. Investment demand picks up again, and the system has to coax metal out of hiding. In that scenario, premiums rise, and the paper price has to chase the physical price. Scenario 3. Volatility forces more margin pressure, leveraged positions get shaken out, and you get one more nasty flush before the next leg. If you've been in this market, you know that third scenario happens more often than people like to admit. Here's the cliffhanger. Which scenario are we entering right now? Because the answer will show itself first in the boring places. Not in the headlines, but in the spreads, in the warehouse category changes, in how quickly dips get bought, and in whether silver can hold the low 80s without collapsing. Let me talk about the $200 target for a minute without naming the people who promote it. A well-known personal finance voice recently said they had purchased several hundred government-minted silver coins around the low 80s and repeated a belief that silver can move dramatically higher over the coming year. Whether you agree with that or not, the useful exercise is this. Ask yourself what would have to happen for that to be plausible. You don't need it to be likely. You just need to know the path. A dramatic move would likely require a sustained wave of investment demand, plus continued dollar softness, plus some kind of physical tightness story that becomes mainstream. That's not impossible, but it is conditional. I'm going to say something that might annoy both camps, silver bulls and silver skeptics. A lot of the time, both sides are right, just at different horizons. In the short term, silver is a leveraged trading instrument. It will hurt you if you treat it like a savings account. In the long term, silver is a strategic material and a monetary metal. It can reward you if you treat it like a multi-year thesis. The big mistake is mixing time frames. If you buy physical, you're usually thinking long term. If you trade futures, you're thinking short term. If you buy miners, you're thinking leveraged medium term. If you mix those without clarity, you get emotional. If you're still with me, here's the tight summary. The dollar is softer. China has a holiday window that can distort liquidity. Inventories in key hubs look tighter than past years. The deliverable category in the U.S. warehouse system isn't huge relative to paper interest. The market is still projected to run a structural deficit, even as supply rises. All of that together means the next move, whichever direction it comes, could be bigger than most people expect. Stay calm, stay curious, and keep your position sizing sane, because the market's job is to tempt you into overconfidence and then punish you for it. I'm going to leave you with a practical plan. If you're buying physical, focus on consistency, not drama. If you're trading paper, respect margins and volatility because the exchange will not rescue you. If you're buying miners, accept that you're buying a leveraged emotional instrument. If you're doing none of the above and you're just watching, that's fine too, because your job isn't to be in every trade. Your job is to be in the right trade at the right size for your own life. If you do that well, you win, even if the market stays wild. Watch the dollar, watch the China window, watch the warehouse categories, watch the spreads, and don't let the internet convince you that you have to believe in a fairy tale to take this market seriously. One more time, if you support this campaign to eliminate copycat channels, subscribe and comment our WFH. My name is WFH. Thank you very much for listening. I'll see you next time. Finally, a quick note. This is educational commentary based on publicly available information and my own interpretation. I'm not your financial advisor, and I don't know your personal situation. Please make your own decisions or speak with a qualified professional before you take action.